If you're debating between paying down your home and investing your money and saving your money, I want you to watch this video. This data is from the beginning part of 2023, and I know mortgage rates have gone up since then, but the same concepts apply now. 23.5% of Americans had a mortgage under 3%. 62% of Americans had a mortgage where they paid an interest rate under 4%. 82% of Americans own a home with a mortgage under 5%, and 91.8% of Americans owned a home with a mortgage under 6%. Now, I know mortgage rates have gone up since the beginning part of 2023, so these numbers might have skewed a little bit, but the same concepts apply now because people who have homes that are 3, 4, 5, even 6% don't want to sell their homes today because now you have to go into a 7.5% mortgage, and a lot of new home buyers are looking at homes saying, I don't want to pay 7 or 8% on my mortgage, which is why you've been seeing home sales slow down. So now, if you own a home, especially here between 3, 4, and 5%, and you're trying to decide, should I pay down my mortgage or should I be investing my money? Let's talk about this, because you can go and take $100,000 and put it into a high interest savings account that is FDIC insured that will pay you 4 to 5% in interest, pretty much guaranteed. And then you could take the profits from that interest and use it to pay down this and maybe this. But if now you're paying 6, 7, close to 8% on your mortgage, now for you to beat the interest rate that you're getting on your mortgage, you'd have to go out and put your money into something like the stock market or into a business idea or into a rental property. That way you can earn enough interest to pay down your mortgage. Is it possible? Absolutely. Is it risky? Absolutely. And this is where now you have to make the decision of what's a better option for you. Because the historical average stock market return is something between 7 to 10%. Same with their housing market, the real estate market. So now, if you can maybe get a 7% return on the stock market, but you can pay down your mortgage and get a guaranteed 6 or 7% return, you can see that the risk to reward ratio isn't that powerful to invest your money as opposed to paying down your home. Because now, if you pay down your home and you get a 6 or 7% guaranteed return, that's guaranteed. If you put your money into the stock market and you might get a 7% return, you're taking on risk. The stock market could fall. The stock market could see 10 or 20% returns, but you're taking on risk. So this is where now I want you to understand this from your own personal standpoint. Where are you in terms of interest rates right now on your mortgage? If you're under 5%, there are ways for you to get virtually, and I don't say risk-free, I say virtually risk-free because everything has some level of risk. But if you're within the FDIC insurance limit, then the risk is very minimal. There are high interest savings accounts. These are regular banks where they will pay you 4 to 5% in interest at the time of recording this video. Yes, there are banks that are paying 5% in interest on your savings. And this money that you can get, the interest, can be used now to pay down this. So now, if you have a 5% interest on your high interest savings, your mortgage is 4%. Well, now you can take the 4% extra that you're getting in interest, pay down this, and have a little bit of extra every single month. And you can use that money to pay down your mortgage even faster, as opposed to taking the money and just paying down your mortgage. But now, if we're talking about 5, 6, 7, 8% on your mortgage, this is where now you want to think a little bit differently. And now you have to decide what is a better investment for you. Can you beat the 7 to 10% return in the stock market? If so, is it worthwhile for you? And this is where now you're going to have to ask a little bit more questions and dig a little bit deeper. See, there are ways for investors to get better returns than the average stock market return. However, that's going to take more time. It's going to take more work. It's going to take more experience, and it takes on more risk. And the question is, are you willing to put in the time? Are you willing to take that risk? Are you willing to get that experience? Are you willing to do that learning in order to make those investment decisions? Because now, if you want to go invest your money into the stock market, you can just invest your money into the stock market. You can put your money into stock market ETFs that will give you exposure to the total stock market or the S&P 500, which will give you the general stock market returns. And again, what we've seen is that the stock market goes up and the stock market goes down. Some years the stock market will grow by 10 to 20%. Other years the stock market will lose value. And so now if you have an additional $10,000 and you're trying to decide if you should pay down your mortgage at 6, 7, or 8%, or put this money into the stock market and just put it into the market and maybe get another 7% return, now you can start to see that, yeah, there's a chance the stock market will outperform your mortgage, but now you're taking on all the risk. Now, you could flip this question a little bit and say, well, maybe I want to be more involved with the stock market. Maybe I want to invest in individual companies. I want to do more fundamental analysis. That way I could see more growth in the stock market. I could see more accelerated growth in the stock market. I think I have better opportunities. Now, can you beat the 7-8% returns in the stock market? Yes, but it's going to take more time. It's going to take more work. It's also taking on more risk for you, because when you go out and you invest in an individual company, well, that company could go bankrupt and you can lose everything. Now, you can make more money if you invest your money into Amazon and Amazon takes over the world. Their stock might double, and now you can see a big return on your money. But Amazon could also go bankrupt, and in that case, it would lose all of your money. So you take on more risk, you can see more return. But now this is where the question goes back to you. What's more important to you? Do you want just financial freedom, where I don't have to worry about my payments? If so, pay down your debt. If you want to be more aggressive, you want to fly in private jets, you want to have more bigger, nicer things, you're going to have to be more aggressive with your investments. Maybe that means not even putting your money into the stock market. Maybe that means you're going to have to work to build a business. Now again, if you want to do that, you could get much higher returns than 6, 7, 8, 9, 10, even 20% returns if you build your own business. But it comes with more risk. It comes with more work. It comes with more time. You're going to have to get more experience. You're going to have to go through more failures. There's a lot more work involved. So, if you're trying to decide now, should I pay down my debt or should I be investing my money? It's not a simple yes or no question. The question depends on you. And it also depends on what type of mortgage you have. If you have a sub 5% mortgage rate right now, well, you got lucky, you locked in that mortgage rate, and I hope you locked it in. I hope you did not get an adjustable rate mortgage when mortgage rates were at 3%. That made me want to pull my hair out when I saw people getting adjustable rate mortgages so they can get the first couple of years at 2.5% as opposed to 3%. If you locked in a sub 5% mortgage, well, you have the luxury of being able to take your additional cash, put it into a high interest savings account today, get that additional interest, use the interest to pay down your mortgage, and put some extra money in your pocket or pay down your mortgage even faster. If you are above 5%, that's okay. But now it makes your investment decision and analysis a little bit more complex, because you don't want to now just throw your money into the market thinking that you are going to get better returns. Because you have to understand now what is the best option for you. Now, everybody should be investing their money. You should always be putting some money into your investments. But the question now is, what's going to give you a better return when you have this extra cash that you're thinking of? Maybe should I pay down my debt, or maybe should I put some money into the market? There's a lot of value of letting your money compound, letting your money grow. But now this is where you want to make that additional question of, if I'm paying 7 or 8 or maybe 8-point-some% on my mortgage, should I continue paying down my mortgage first, or should I invest my money first? Because the higher mortgage rate is, the more valuable it is to you to pay down that mortgage faster. Now, before I go any deeper, if you are interested in learning more about how to start investing, my team at Briefs Media put together this amazing ebook titled How to Build Wealth as an Investor, that'll walk you through from the beginning the basics of how do you build the mindset of an investor, to then how do you save your first couple $1,000s, to then what are the different investing options for you. How do you start investing for cash flow? What are the different investment tools out there? Then it goes into how do you spend your money smartly, to how do you earn more money smartly, and how do you protect your assets. This ebook is completely free, and if you want to get a copy of this ebook for yourself and read it for free, I got the link to how you can download this ebook down in the description below, or you can go to briefs.co/ebook. Now, if you've been on the sidelines and you're thinking about buying a home and you're saying, you know what, I'm just going to wait for mortgage rates to fall to buy a home, I want you to understand a couple things. Number one, if mortgage rates were to fall tomorrow, what would happen in the housing market? You would see more people want to go out and buy a home. So you'd see more competition between buyers. So understand that. And number two, if mortgage rates were to fall tomorrow and you owned a home today, you can always refinance your mortgage and go into a lower interest rate mortgage. Now, is there a fee to refinance? Yes. But if mortgage rates drop far enough, then that could justify you paying those refinancing fees. So the big thing now, if you are in the market for a home, because I know the home market, housing market has been absolutely crazy the last few years, there's a couple things that I want you to understand. Number one, please do not chase a home. Do not chase any asset. Number two, don't treat your home like an asset. Treat the home that you live in like a liability, because what ends up happening to a lot of people is you go out and you want to buy this dream home, this dream investment, which is fine. Nothing wrong with buying a dream home. But a lot of times people think of it like an investment, and now they say, you know what, if I go bigger, it's going to make me wealthier. And this is what justifies people now to stretch themselves too thin, and now you're essentially living paycheck to paycheck just to make the payments on your home. You have this big, grand home to take care of, and then You got to pay for the mortgage, you got to pay for the insurance, you got to pay for the property taxes, you got to pay for the monthly maintenance costs and everything in between. And then you have no money left over to invest your money into other assets like stocks and rental properties, because all of your money is going to pay your monthly payments. Now, when you do that, you never have the opportunity to actually build any real wealth because all of your money is going to pay down this house. And I want you to also understand that when you are working to pay down your mortgage, your interest is front loaded. That means for the first half of your mortgage, if you get a 30-year fixed rate mortgage, the first 14 years of your mortgage, the majority of your payment is going directly into your banker's pockets with interest. So if you're paying $2,000 a month for your mortgage payment, for the first 14 years, more than half of the $2,000 is going directly into your banker's pockets. In the first year of that mortgage, nearly all of the $2,000 you're paying every month is going directly into your banker's pocket with interest. So if you are sending additional money to your lender to pay down your mortgage faster, make sure the additional money you're sending in is going directly to your principal balance rather than paying your next month's balance. What banks want you to do is they want you to send in additional money to pay down next month's balance, because all you're doing is giving the banks their interest faster. But what you want is to pay down the principal balance faster, because that's going to actually allow you to get out of that mortgage quicker. So just something to keep in mind, that if you're paying down your mortgage early, make sure you send your money in to pay down the principal balance rather than just paying your next month's mortgage. So if you are in the market for a home, remember, this home that you're buying, treat it like a liability. And then number 3, remember, you're buying a home not to make money, you're buying a home to make memories. If you're trying to buy a home to make memories, stop trying to chase the market. Stop trying to chase everything. Just find something that's within your budget, something that you can afford. And when it comes to affording the home that you live in, that means you got to afford 3 things. Number 1, you got to afford the down payment. Number 2, you got to afford the monthly payment. And number 3, you got to afford the move-in costs. These move-in costs are often forgotten about. But to go into this home, that means now you're going to probably have to hire movers to get your stuff from your current house or home to this new place. And that also means now, if you have to make renovations in this new home, what's going to be the cost of that? If you want to upgrade the kitchen and the bathroom, what's the cost of that? If you want to buy new appliances, what's the cost of that? If you're going to buy new mattresses, what's the cost of that? If you're going to buy new furniture, what's the cost to that? Because anytime you want to move into a new home, you want to make it your home. You want to make it feel like home. And that has a price to it as well. So when you're budgeting to buy a home, I don't want you to just budget for the down payment and the monthly payment, though I do want you to budget for those 2 things. Also budget for the move-in costs, because that's something you have to factor in as well, and do not chase the market. Please, the housing market goes through cycles. We've seen booms in the housing market, we've seen busts in the housing market, and just like every other asset class, housing market moves like this as well. No housing market, no asset class can stay in one place forever. Patience is very powerful, and patience can be very hard when you hear about all this crazy stuff happening in the housing market. However, this is where it's important for you to remember why you're buying a home. You're buying it to make memories. That's the number 1 reason. And if you're buying it to make memories, you want to make sure that your liability that you're buying is going to be within your budget. Now, can this liability make you money? Sure, but it also might not. And this liability is a money pit until you go and sell your home, which is why, again, it's important for you to be financially smart as you're shopping for a home, to make sure whatever you buy is something that you can comfortably afford, and that is not going to sacrifice your ability now to actually invest your money into assets that will actually make you more money. Read this title from Fortune magazine. The US housing market has gotten so expensive that incomes would have to jump 55% to make buying a home affordable. America is currently experiencing one of the least affordable housing markets of all time. Now, there are 3 things that could happen to make housing more affordable. Either incomes could rise